Larry, Whiskey Business, Alex, and everybody else who's going to be joining us for this live stream, welcome. I'm hopefully your favorite estate planning attorney, Paul Rabelais, here with a topic that I got to tell you, it's not easy to comprehend and understand upon your first exposure to this information. So I'm going to take it like you know nothing. Maybe you've heard of the estate tax, you maybe know a little bit about it, but I really don't want this to be over everybody's heads. I want to structure it so that really anybody who has the vaguest concept of estate planning and estate taxes can grasp all of what we're about to cover here in this live stream. So welcome everybody. As usual, if you have something you'd like to contribute to the chat, which is typically maybe a question, a comment, or experience, something positive, feel free to add it to the chat. I've got some information I want to present without looking at the chat. And then once I present that information over the next maybe 20 minutes or so, then we'll look to the chat and address. The reason I do the live stream is so that we can have a chat. We can have some little bit of back and forth, a little bit of community involvement. It's been nice seeing over the last several weeks how the participation and seeing some of the regulars and seeing the level at which the chat it's really impressed me. Some of the questions that are being asked out there, they're really top-notch, high level. So great to see that. That always helps. All right, so the topic for this live stream: when to file a federal estate tax return after a married person dies. That's a mouthful right there. So we're going to get into a lot of stuff about the estate tax, a lot of stuff about married people, a lot of stuff about tax calculations, but we'll take it slow, one step at a time. Once the live stream's over, I'll post chapters that you can go through at the bottom of the screen if you're watching a recording of this live stream. So, okay, Chelsea, nice to see you as well. All right, saw that chat pop up. So we'll talk about what is the federal estate tax return. We'll talk about when it's required to be filed. Then we'll talk about the federal estate tax marital deduction, all terms that may seem foreign to you right now. And then we'll get into when an estate tax return should be filed, even though it's not required to be filed. All right. By the way, Alex, I hope to answer your question. Maybe you can tell me at the end of the live stream whether I answered it, but I'm going to give it my best shot. Talking about if there's a credit shelter trust, do you still need to file a Form 706? So you're right in the you're right in the gut of what we're going to talk about. So let me just make a blanket statement, and then I'm going to back it up with a lot of information. I would say that the answer to when to file a federal estate tax return after a married person dies, under two circumstances. One, when you have to, because the rules say you're required to file under these circumstances, that we'll talk about. And then number two, a federal estate tax return ought to be filed after a married person dies when it's not required, but you think it will save taxes in the long run. So again, that's just my blanket statement. Probably means nothing to you yet. File a federal estate tax return after a married person dies if it's required to be filed, or even if it's not required to be filed, but it could save some money and save some taxes in the long run. All right, so before I start getting into the rules, throughout this live stream, I'm going to focus on two different examples. I'm only going to give you the first example first, and then after I hit the relevant points that relate to that example, I'll give you the second example, which applies to many more people. Don't yell at me when I give you this first example and say, Paul, I wish I had an estate that size, or Paul, I don't need to listen to this because my estate's not that large. I got to talk about an example of the large estate first. And then example number two is the much, much smaller estate that applies to many, many people. So just hold on. We'll get to an example that may apply to you in just a few minutes. So the first example that I want to give, and if you've been on these live streams before, you hear me talk about Fred and Wilma Flintstone, good, TV show from back when I was a kid, 50 years ago or whatever. I even think it was that long. So I'll talk about Fred and Wilma Flintstone. And the first example, big numbers. I don't want to apologize because I'm telling you big numbers, but the examples apply if you use these big numbers. We'll get to smaller numbers in a minute. And again, I'm going to be repeating myself a couple of times because sometimes for you to get it, I've got to repeat things and sometimes say it a little bit of a different way. And then finally it might start to sink in. So that's my challenge. Okay, so the first example, Fred and Wilma, big numbers, each have an estate of $15 million. So between the two of them, they have $30 million. And we'll say each one has $15 million. And let's just say that when each of them passes away, the estate tax exemption amount is $7 million. Quick backstory on that for people who pass away in 2024, which is what we're in now. Big number. They can have the estate tax only applies if someone has more than $13.61 million if they die in 2024. It'll be an even bigger number in 2025 when it gets adjusted for inflation or at around the end of the year. But then due to the Tax Cuts and Jobs Act of 2017, on January 1, 2026, this estate tax exemption will be cut in half. So for purposes of our examples here, I'm hoping if you're watching this in 2024, I'm hoping you make it to 2026. But know that it may be a little different if you, your spouse, your parent, whoever dies in 2024 or 2025. But you just gotta make it a little more than a year and a half to get to 2026. All right. Okay, so our example, Fred and Wilma each have an estate of $15 million. And let's say when Fred and Wilma each die, their exemption is $7 million, which is probably going to be in the ballpark of what the exemption will be in 2026 moving forward, unless Congress acts to change all of this, which they can do at any time. All right, so what is the federal estate tax return? It's number, most of you are familiar with Form 1040. That's the income tax return. The estate tax return is IRS Form 706. Some people confuse the estate tax return with the gift tax return. So just to clear up the lingo, when someone dies and an estate tax return is filed with the IRS, that's IRS Form 706. When someone makes a taxable gift, which is a gift to someone in excess of this annual exclusion amount, which is $18,000, if you make a gift to someone and during the calendar year, those gifts exceed $18,000, you're required to file a gift tax return, which is a different form number, IRS Form 709. That's where you report that you're using some of your estate tax exemption by making gifts to someone in 2024 in excess of $18,000 per donee. So just as an example, if you gave your daughter $118,000 in 2024, you would be required to file a gift tax return showing that by making a gift of $118,000, you used $100,000 of your estate tax exclusion amount. Now, when you die, if your exemption is $7 million, you'll only be able to leave $6.9 million free of the 40% estate tax because you used $100,000 of your gift and estate tax exclusion amount during your lifetime. So anyway, those gifts are reported on Form 709. Okay, so what gets reported, what gets included in the estate when somebody dies, what assets get reported on the estate tax return. Essentially, we could talk for hours on that, but if you own it, when you die, it's considered to be an asset that is counted toward the estate tax. Not only all of your real estate that you own, your bank accounts, also life insurance proceeds. If you owned the policy when you passed away, digital assets are part of the estate. If you have an ownership interest in community property, let's say you own it 50-50 with your spouse, whether it's community property or jointly owned with someone else or with a spouse, your ownership interest in that property is part of the estate. Some people mistakenly believe that, yes, this person died and they left some assets to others outside of probate. So aren't only the probate assets considered part of the estate for purposes of the estate tax? No, that's not the rule. So if you have a $5 million IRA and you leave it to your son or your children, that even though that goes to them outside of probate, it's still counted as part of your estate for federal estate tax purposes. Okay, now let's jump into, and we get some more hellos. Oh, good to see all the hellos from everybody. By the way, feel free to like, subscribe, all that good stuff that people ask you to do when you watch YouTube videos. Helps the channel. Now let's roll into, when is that IRS Form 706 required to be filed? Not necessarily even just for a married person, for anyone who dies. So the executor is the person who's responsible for filing the estate tax return, and there is a filing requirement if the gross estate, so the value of all of the assets in the estate, and oh, by the way, plus any what's called adjusted taxable gifts. If you did use some of your exemption during your lifetime, let's say you used $1 million of it by making some large gifts during your lifetime, if your gross estate plus those adjusted taxable gifts, and you die in 2024, is if it exceeds $13.61 million, that's the estate tax exemption, or sometimes people call it the estate tax exclusion amount. If your gross estate is more than $13.61 million, there is a requirement that an estate tax return be filed. Sometimes a gross estate is more than $13.61 million, but the net estate is less than $13.61 million. Even though the net estate is less, still the requirement to file the return because the gross estate is 13.61. What's the difference between gross and net? Well, someone could have a $20 million gross estate, but they had a number of deductions. Typical deductions include debts that the person had. They may have had $20 million of gross assets, but they had $5 million of debts. That brings their net estate down to $15 million. Maybe they left some assets to charity. If they left another $3 million of assets to charity, now their net estate is $12 million. And maybe they left $5 million of assets to their spouse. That's a big one that we're going to talk about here in a moment. All those things are deductions from the gross estate before the net estate is calculated for tax purposes. But nonetheless, for the filing requirement, it's the gross estate number that the IRS looks at for purposes of requiring to file an estate tax return. Now, who is required to file that? I mentioned a moment ago, the executor is required to file it, and that executor includes the executor that's named in the will, or sometimes that's called the personal representative, or sometimes a person dies without a will, so there's an administrator of the decedent's estate. And if none of these is appointed or qualified or acting, then really every person who's in actual or constructive possession of any property of the decedent is considered an executor and must file a return. So let's say Fred Flintstone had a $10 million IRA. His exemption is $7 million. He dies in 2026, and he leaves his IRA to his neighbor Barney. So Barney's the one, even though there was no probate and no executor and no administrator and no probate proceeding, Barney is considered an executor for purposes of being required to file the federal estate tax return. By the way, you might want to keep this in your back pocket. This one's really gonna apply to so many people out there, and keep it in the back of your mind. The IRS, if you do owe tax, and you owe, if your spouse dies or your parent dies, and federal estate tax is owed to the IRS, just keep in mind that the IRS cannot accept a single check, including a cashier's check, for amounts of $100 million or more. So it's got to make you mad enough that or as a result of someone who died, their estate owes the IRS, let's say $180 million. Bad enough that that's the case, but on top of that, you can't write a check if you're the executor to the IRS for $180 million. They won't accept it. So you'll have to divide that up into two checks, maybe make two checks for $90 million a piece. And now you're happy because the IRS will accept that $180 million of payments that you're making. Just keep that in the back of your mind. You never know when you might need that. All right, and there's penalties for late filing, for late payment, for underpayment due to valuation understatements. That's always a tricky one. Somebody owns an apartment building or a business that's subject to, subjective valuations. It's based on somebody's opinion of what a willing buyer and a willing seller would agree to, neither being under any compulsion to buy or sell. But how do you value a business? It's tough. There's things that you take into consideration: the assets, the prior earnings, the projected future earnings. Lots of things you take into account. But reasonable minds can differ in their estimation of what assets like that are worth on the date someone dies. So so the IRS penalizes you if it's determined that you made an underpayment of estate tax due to a valuation understatement. You said the person who died, their business was worth $6 million. The IRS thinks it's worth $15 million. And so that all gets hashed out. Okay, so now we've talked about so far the example where Fred died. Fred and Wilma each had $15 million. They had $30 million together. Fred had $15 million. He died in 2026. His exemption was $7 million. Certainly there's a requirement that an estate tax return. Fred had a will named Wilma as his executor, so Wilma's responsible for, she'll probably hire the lawyers, the accountants, whoever, to complete and file the estate tax return, which is due 9 months from the date that Fred died. Some people think it might be due on April 15th along with the income tax return, but it isn't. It's due 9 months from the date of death. Okay, so now we need to jump into what's called, as this whole live stream is about a married person dying, we need to talk about the main deduction affecting someone's estate tax return when they're married and they die. So we need to talk about the federal estate tax marital deduction. Okay, this is where I'm going to try to keep it simple and not go over your head. An estate is entitled to a deduction for property interest passing from the decedent, the person who died, to the surviving spouse. So maybe Fred had a will, and in his will, he said, I leave all of, his estate was $15 million. And he said, I leave all of my Apple stock to my wife, Wilma. And when he died, his Apple stock was worth $10 million. So his gross estate was $15 million. That triggered the filing requirement. But because he left that $10 million of Apple stock to Wilma, his estate gets a deduction. Gross estate, $15 million, filing requirement. $10 million deduction pursuant to the federal estate tax marital deduction, because that was property of Fred's that passed directly to his spouse, Wilma. And so now with just that $10 million bequest to Wilma, Fred's net estate is now $5 million, $15 million gross estate, minus the $10 million marital deduction bequest. Now his net estate is $5 million. And now we know there's not going to be any tax due because his exemption was $7 million, but his net estate was $5 million. Maybe his net estate would go even lower if he had some other deductions to charity or other deductions that may cause his net estate to be even less than $5 million. So, but you ought to start getting the idea. If you leave something to your spouse, if you leave something to your surviving spouse, your estate gets a deduction from the gross estate before that net estate is calculated. Okay, so that's the marital deduction for what I call outright bequests to the surviving spouse. I leave my Apple stock to Wilma. Or maybe Fred had a $5 million IRA and he named Wilma as the beneficiary of his $5 million IRA. That also is another bequest that passes to Wilma under this marital deduction. The marital deduction is automatic. It just it has to happen. I guess Wilma could disclaim or refuse some of it, and of course, if she does do a timely disclaimer within 9 months after Fred dies and follows all the formalities, then those assets would go to other people and wouldn't pass pursuant to the marital deduction. But let's not talk about that right now. So it just, that marital deduction is automatic if you leave it to your spouse. And the idea behind the marital deduction is married couples ought to be able to arrange their estate, arrange their legal affairs so that when the first spouse dies, those legal affairs can be set up so that no estate tax is required to be filed when the first spouse dies. But because of the marital deduction, it reduces the net estate of the first spouse to die, but it does cause assets to be lumped into the estate of the surviving spouse. Sometimes it makes that surviving spouse's estate larger than anticipated and causes estate tax to be due upon the death of the surviving spouse. But nonetheless, here's our example. Fred had $15 million, left his $10 million of Apple stock to Wilma. No estate tax is due. Estate tax return must be filed when Fred dies, but estate tax won't be due because his net estate will be less than the $7 million exemption amount. Now we need to start talking about, so that's the marital deduction for outright bequests to the surviving spouse. Now we need to start talking about legal mumbo jumbo, legal gobbledygook, the terminable interest. Okay, so here's the deal. An estate may elect to claim a marital deduction for, I hate to even say it because it's a mouthful, qualified terminable interest property. QTIP property is how it's referred. The effect of that election is that the property, if the election is made, which we'll talk about here in a minute, then the property is treated as passing to the surviving spouse under this marital deduction rule. All right, so let's talk something different here. Let's say Fred's still with his $15 million and his $10 million of Apple stock. Fred's a little reluctant to just leave that to Wilma because, Wilma's pretty. And if Fred dies, Wilma's still kind of young and maybe Wilma may find someone, may remarry, may fall in love. And then Wilma may wind up leaving that $10 million of Apple stock to her next husband or to some other individual that may influence Wilma into kind of making a mistake or doing things that Fred and Wilma would not have done if Fred and Wilma were in that right mind. Fred says, look, Wilma's got her own $15 million estate. She can do whatever she wants to with. I don't want to lump my $10 million of Apple stock into Wilma's estate, and then Wilma goes and leaves all of that $25 million to someone else. I want to provide for my spouse, Wilma. So I think what I'm going to do is I'm going to leave that stock in a trust for Wilma. Maybe Fred names Wilma as the trustee of that trust. Maybe Fred names somebody else as the trustee of that trust. And maybe the trust's terms will say something like, I want Wilma to get all of the income from that trust for the rest of her lifetime. So if that Apple stock or whatever those trust assets are produce some interest or dividends or rental income or other income, that income's going to go to Wilma, at least every year for the rest of her life. And then that trust says, well, when Wilma later dies, I want all of those trust assets to revert back to my heirs, is what Fred says. Maybe their child, maybe other people that Fred would want to inherit after both Fred and Wilma pass away. So that bequest to a trust for Wilma is a terminable interest because once Wilma dies, Wilma can't direct where those assets go. They must go back to where Fred said they must go. All right, and because that's a terminable interest, that doesn't automatically qualify for this marital deduction. But if Fred sets it up to qualify as what's called a QTIP trust, which means Wilma gets the qualifying income interest for life, and that's what we said. She'd get all the interest, dividends, rental income. She'd get that for life. And if when Fred dies, okay, so let's go back. Fred had $15 million. He left $10 million of Apple stock to this QTIP trust. Wilma gets the income for life. When Wilma dies, the assets revert back to Fred's beneficiaries. Then that $10 million bequest is, it meets the requirements of QTIP property, but in order to qualify for the marital deduction, a QTIP election must be made. Holy smokes, Helen, you didn't have to do that. Fantastic. That was nice of you. Anyway, let's go back to that. That hit me like a ton of bricks on the chat. Okay, so so now let's go back. I'm going to repeat myself. In our previous example, Fred left his $10 million of Apple stock to Wilma, automatic marital deduction, automatic deduction from Fred's estate, automatically included in Wilma's estate. But now we changed the facts up a little bit. Fred had a $15 million estate and a $7 million exemption when he died in 2026. He left his $10 million of Apple stock to a trust for Wilma. Wilma gets the income for life, qualifies as for QTIP treatment. And it doesn't qualify for the automatic marital deduction. So now, since it doesn't qualify for the automatic marital deduction, then now Fred's net estate is $15 million. And now estate tax is going to be due because it's more than $7 million. However, this bequest to a QTIP trust qualifies for marital deduction treatment. And if the estate tax return is timely filed, and if what's called a QTIP election is made, then that bequest to the QTIP trust will qualify for the marital deduction. Let me give you the figures. Fred had a $15 million estate, $7 million exemption when he died in 2026, left $10 million to a QTIP trust for Wilma. Okay, so what will likely happen is the first $7 million, Fred can do whatever he wants to, and there won't be any estate, and that he'll use up his estate tax exemption with that $7 million. But Fred had $15 million when he died, so that excess $8 million, even though Fred left $10 million to the QTIP trust for Wilma, Fred's executor can file an estate tax return and make a QTIP election so that $8 million of that $10 million that's left to a QTIP trust will pass pursuant to the marital deduction. Now Fred has used his $7 million exemption. No tax is due as a result of Fred's death. And the excess $8 million that a QTIP election was made for, that there's a deduction from Fred's estate to that to get his net estate down to $7 million. But that $8 million from an accounting standpoint will be included in Wilma's estate for estate tax purposes when she dies. So she'll have her own $15 million estate, plus she'll have the $8 million of the $10 million QTIP trust. That $8 million for which a QTIP election was made will be included in Wilma's estate. Okay, all that was a mouthful. Maybe the bottom line that you need to know is if somebody dies with more than the estate tax exemption and they're leaving assets to a trust for their spouse that qualifies as a QTIP trust because they provided that their surviving spouse gets this qualifying income interest for life, then still it can be arranged through the proper estate tax returns with the proper election that no estate tax has to be paid, within 9 months after the first spouse dies, that the tax on those assets essentially gets deferred until the surviving spouse dies. Okay, so that's the example when Fred died with the humongous estate of $15 million, more than the $7 million exemption. He leaves assets to a QTIP trust. He dies. Yes, an estate tax return is required to be filed because his gross estate exceeds the $7 million. And on that estate tax return, because he left assets to a QTIP trust, a QTIP election will be made so that the assets that exceed Fred's estate tax exemption will qualify for the marital deduction, will be deducted from Fred's estate, and will be included in Wilma's estate when she passes away later. Okay, so that's the large estate issue. Now let's talk about the smaller estate. Okay, so now the one that applies to more people. Now let's forget the fact that Fred and Wilma each had a $15 million estate. Let's say now that Fred and Wilma each had a $3 million estate, $6 million between the two of them, and Fred dies in 2026 with a $7 million estate tax exemption. So Fred dies in 2026, His estate's $3 million, the exemption $7 million. So clearly no tax is going to be due. In fact, clearly there's no requirement that a federal estate tax return be filed after Fred dies because his gross estate does not exceed the exemption. His gross estate is $3 million, exemption $7 million. So on first thought, you're thinking, well, let's not do that. If we don't have to do it, let's not do it. I don't want to do anything that the IRS says we don't have to do. But let's explore that a little further, because now we really have to start talking about this concept of portability, or portability of the deceased spousal unused exclusion. Boy, that's a mouthful. Okay. All right. So here's the deal. Fred died. He has $3 million. Wilma has $3 million. All right. So now with portability, which I think was enacted somewhere around 2010, estates can elect to transfer any unused exclusion to the surviving spouse. This is a great deal. All right. So let's apply the numbers and look at the example. So Fred died with $3 million, and now I've got to give you two sub-examples. Maybe in the first example, he left his $3 million to, I guess, their child, who was Pebbles. Wilma still had her $3 million to live off of. And so when Fred left his $3 million to Pebbles, he used up $3 million of his $7 million exemption. His gross estate is $3 million. His net estate is $3 million. But he died in 2026 with a $7 million exemption. He still has $4 million of unused exclusion or unused exemption, because he had an exemption of $7 million, but he only owned $3 million. So now with portability, even though there's no estate tax return that's required to be filed because his gross estate did not exceed $7 million, it's probably a pretty darn good idea, especially if Wilma's going to live for several years, to file a Form 706 timely within 9 months after Fred dies and make what's called a portability election, because now Fred's estate can elect to transfer that $4 million of unused exclusion amount $7 million. He only had $3 million, $4 million unused. But if Fred's estate files an estate tax return and makes the portability election, now that $4 million of unused exclusion amount that Fred's estate has gets tacked on to Wilma's exclusion amount to protect even more from the estate tax when she dies. Let's look at the numbers. Fred dies, $3 million, $7 million exclusion, $4 million of unused exclusion amount. Everybody's saying, yeah, we think you ought to file that return, Wilma. You're the executor. File that return, make the portability election. You'll show that you'll be transferring Fred's $4 million of unused exclusion to Wilma's estate. Now, Wilma dies 10 years later. She has a $7 million exclusion amount. But does she get to protect $7 million from the estate tax when Wilma dies? She actually gets to protect $11 million from estate tax when Wilma dies, because she has her exemption of $7 million. Plus, because she filed the return when Fred died and made the portability election for Fred's unused exclusion, she gets her $7 million, plus she gets $4 million, the $4 million of Fred's unused exclusion amount. So she can have up to $11 million when Fred dies without incurring any of the 40% federal estate tax. So will she have $11 million? Who knows? She only has $3 million when Fred dies, but who knows? She may make some good investments. She may work. She may live a long time, and just a natural appreciation. It grows and grows and grows. But it certainly doesn't hurt to tack on Fred's unused $4 million exclusion amount onto Wilma's. There's really no downside to that. Now, if Fred had left everything to Wilma, now under the marital deduction, Wilma would now have the $6 million estate. But because Fred left everything to Wilma, Fred's estate $3 million, all went to Wilma under the marital deduction. Now Fred's net estate is zero, and he didn't use any of his $7 million exclusion amount. So again, Wilma, file the return, make the portability election. $7 million was Fred's unused exclusion amount that got tacked on to Wilma's exclusion amount, whatever that might be when she dies. So let's go back to the Fred left it all to Pebbles and had the $4 million unused exclusion amount. We don't know what the exclusion amount will be when Wilma dies in 20 years. It could be $1 million. It could be $15 million. So because of all that uncertainty, we want to make sure we tack on Fred's $4 million of unused exclusion amount onto Wilma's exclusion amount and it could have zero tax savings depending upon the size of Wilma's estate and the exclusion amount when Wilma dies, or it could save millions in estate tax because Wilma gets this much larger estate tax exemption. All right, one other thing worth mentioning is under the each of them had a $3 million estate. Let's say Fred left it to what's called a QTIP trust. Still no estate tax when Fred died. His net estate's well under $7 million. But now there's this, when Fred dies, do you just let things be? And Fred's $3 million will go into a trust for Wilma. And Wilma will have her $3 million. She'll have the $3 million that Fred left in a trust for her. But the concern is only Wilma's $3 million will get, or whatever it grows to, will get a step up in basis when Wilma dies, not the assets in Fred's trust that he left for Wilma. So I guess there's an example of, and you'll see this more now that we have portability. There's some decisions that can be made when the first spouse dies. Hey, do we want Fred's $3 million? Do we want to file a return and make the QTIP election to include Fred's $3 million in Wilma's estate when Wilma dies, in order that all of it get another step up in basis when Wilma dies in the future? Okay, so that's often called a Clayton election based on a court case. So that's a scenario that families may decide to file the estate tax return, even though it's not required, not only make the portability election, but also make this marital deduction or QTIP election to qualify for the marital deduction, so that for tax purposes, all of the assets are included in the estate of the surviving spouse. And then all of the assets get a step up in basis when the surviving spouse dies. That's a beautiful thing, because then when the kids go to sell assets after the surviving spouse dies, there's little or no capital gains tax to be paid because all of it got a step up in basis when the surviving spouse died. Okay, so that's a mouthful. Let me try to summarize here. We have a federal estate tax, and in 2024, when somebody dies, the first $13.61 million is exempt from the estate tax. The estate tax, generally speaking, about a 40% tax on everything in excess of $13.61 million. If someone dies and they have a gross estate that exceeds $13.61 million, they have to file the return with the government within 9 months from date of death. However, due to, I'm getting excited, due to certain deductions and elections that may be made, the net estate may be less than the exclusion amount after taking advantage of the marital deduction, the QTIP election, the charitable deduction, and other deductions. So the idea here is the estate tax rules essentially are structured so that if the planning is done right, married couples are entitled to use both of the estate tax exclusion amounts that each of them has. And if they set things up right and they make the right elections after the first spouse dies, there's not any tax due until after the surviving spouse dies, and tax is due only if the total assets exceed 2 times that estate tax exclusion amount. So the key concepts to remember here are probably the marital deduction. Things that qualify for the marital deduction get a deduction from the gross estate of the first spouse to die. That's a big deal. Portability is now a really big deal when the first spouse dies, even though an estate tax return is not required to be filed. Perhaps one should, based on the numbers and the life expectancies and the assets, so that the surviving spouse not only gets their own estate tax exclusion amount, but they get the unused exclusion amount of the first spouse to die. And then there's also lots of considerations around the step up in basis and elections that can be made when the first spouse dies. And quite frankly, the way the couple sets their estate plan up from the get-go, that can affect what assets get a step up in basis when each spouse dies. Love the step up in basis because step up in basis means untaxed appreciation of capital assets never gets taxed, which is a good thing. Okay, so mouthful there. Thanks for all of you for hanging on. We've got, let me go back here and see what we got. A bunch of hellos from everybody. Alex, I hope I asked your question. If first spouse dies, they leave assets to a credit shelter trust, do you still need to file a Form 706? The estate tax is, like I said, the 706 is required to be filed only if the gross estate of the first spouse to die exceeds the exclusion amount, which in 2024 is $13.61 million. But it may be advantageous to file it anyway, either to make this QTIP election or to make this portability election, so that the unused exclusion amount of the first spouse to die gets added to the surviving spouse's exclusion amount. All right. Hey, Chelsea. Hey, Shane. Hey, Lacey. Hello, Felicia. Susie, you're amazing. Okay, it's the Form 709. See, I think I probably read your mind there. You say it's the Form 709 that you'll start using this year, not this. Okay, so you're right there with me, Whiskey Business. You're not the first. You don't even have to say, oops, no apology necessary. I even had it in my presentation. People mix up the 706 with the 709. All right. Great, Ray. I've seen your name before. Good to have you here. Larry, thanks for reiterating to hit the old like button. I think you have to hit the subscribe button to contribute to the chat. So thanks for that as well. Helen, you're awesome. Ann, you're awesome. Larry, better late than ever. To Ann. I was wondering where Ann was. I missed her emojis, but we got them. Fantastic. Y'all all have a great night. Perhaps we'll see you next week, heading to Texas for another family wedding this weekend. Y'all take care.